Um, so we are starting our today's session. Remember the last time we were discussing about the capital budgeting. We did some few questions there, and we discussed about the techniques of handling risk. I remember we were able to talk about the accounting rate of return. We were able also to discuss about the payback period. Those are the traditional models. We also had the modern techniques, which we talked of having the net present value, which we said when you find in a question an examiner has not even told you the model or the method that you have to use, then you have to be using the net present value to advise an investor. We have the internal rate of return. We have the profitability index, the discounted payback periods, and then we have the modified internal rate of return. When you look on those aspects, I am not just going to be repeating everything because in our first video, we discussed about what does all these methods entails, and the methods which are basically used for the computation. So much of the questions which have already been tested over the years, and I would like to start with a question tested on May 2016. There is a question there. May 2016, we have question number 1B. Allow me to start from that point. May 2016. May 2016. 2016, where is it? Okay. So the May 2016 is here. These are advanced. We are looking for the financial management. So let me check. Let me search again here. Let me look whether I can be able to get the right data. So we have 2016. I hope you are able to download the same. Okay. So this question was tested is going to be expounding about the methods which we have to use in the computations. It also talks about, we are going to be repeating about a concept of annuity and lump sums. And we look on how we can be able to play with it. Now, when I look on the question of, I have said it is May 2016 question 1B, discusses about investment projects where we are being given some cash flows. Year zero is already provided there. We have 4 projects, ABCD. The cash flows are already given from year 0 to year 3. Then we are being told the firm's opportunity cost of capital is 15%. So the required, we are being told to rank the project using the payback periods. Secondly, we are being told to rank the projects using the net present values. And that is not a hard work to do. So when an examiner is giving you this kind of a question, and you just want to get a solution out of it, it's very simple. You just come you just come straight away in your books, and I would like to start with the let me start with the computation of the NPV, right? Let me start with the NPV. I'll be able to come back to the other one, question number 1B, right? We are doing FM, correct? A topic of capital budgeting. A topic of capital budgeting, that is what we are going to be doing. So in this case, the question is already asking us about the computation of the NPV. And I remember when we were computing the NPV, we said, is it possible for us to use, to look on the cash flows as provided by the examiner, right? Let me just look on the cash flows as provided. When I look at the first cash flow, for example, we have the first projects. So let me start with projects A. Let me start with project A. So you just come here, you say, we are doing project A, correct? Very simple. Another project A, when I look on the cash flows which are generated in each year, these cash flows are similar. So in this case, it means if you want to get, you need to get the NPV. We say, let me just write a formula here to remind you. We normally take the present value of cash inflows, the present value of the cash inflows, then we multiply by the present value of the cash inflows, you multiply by the present value interest factor, PFIFA, because we are using the PFIFA because the cash flow which is already generated in each year is similar, right? So we talk about R% N years minus our initial claim. So in our case here, it means the project of ours takes only 2 years, correct? It normally takes only 2 years. And taking 2 years, it is very simple for us to understand that, let me talk about the cash inflows to make sense for you. We multiply by that, minus the initial place. So in this case, it means the cash flow generated by project A each year will be 500,000. We multiply by the present value interest factor annuity. The rates, right? What is the cost of capital is provided by the question, which is 15%. And this project only takes 2 years, minus the initial outlay of 1 million, right? So in simple terms, it means you just need to take 500,000, we multiply by, we say the formula which we can be able to use here is 1 minus 1 plus R you raise power N, you divide by R, right? So let me take my calculator. So in this case, it means I just need to take the rates. You can see here, it is 0.15. So plus 1, you take 1.15. You raise to only 2 years, negative 2 years. So we say 1 minus answer, we divide by 0.15. You normally get 1.6257, right? 1.6257 minus 1 million. So how much it is? So when I multiply this by 500,000 minus 1 million, you're going to be getting negative 187, 146. Allow me to round off the decimals. So let me go to project B. Project B now, right? The project B, when I look on the cash flows, when I look on those cash flows, you can see year 1, there is no any cash flow which is going to be generated. But in year 2, we are going to be generating some cash flows there. And year 3, we are going to be generating 850. These cash flows are not similar. So in this case, it means, if I want to get my NPV in this case, it means this is a lump sum question. So I'm going to be taking my cash inflows. So the first one will be 650,000. We multiply by P5. In this case, I'm not going to be using the annuity because the cash flows are not similar. 15%, we talk about 2 years, plus, now we are looking at 850,000 multiplied by present value interest factor 15%, 3 years, minus our initial outlay of 1 million. Very simple. So in this case, it means we're going to be taking 650,000. We multiply by what? The formula for this, we said, is 1 plus R, we raise power negative N. So 1.15, we raise power negative 2. Right? Getting 0.7561 plus 850,000. We multiply by how many when it go to year 3? It means it's 0.65. Using the formula now, 0.6575 minus 1 million. So what is my answer here? It means my answer will be 650,000 multiplied by 0.7561 plus 850,000. You multiply it by 0.6575 minus 1 million. We are getting 50,340. We go to project C. So under the project C, it means there are some of the cash flows also again, but the cash flows which we are getting there, they are called irregular cash flows. So when you look at it, to get your NPV, you're going to be using PFIF. So the first cash flow generated in first year is 300,000 multiplied by the present value interest factor. We talk about 15% 1 year plus, right? We add what? 500,000. We multiply by the present value interest factor, 15%, 2 years, plus third year, we are generating 1 million times the present value interest factor, 15%, 3 years, minus 1 million. So how much is this? So in simple terms, it means you're going to be taking 300,000, right? We multiply by what? The formula we are using for lump sum is there. So it means I just need to take 1.15. I raise for -1, get it 0.8696 plus 500,000. We multiply by, we raised power 2 now, get it 0.7561 plus 1 million. We multiply by what? You raised power 3, get it 0.6575 minus 1 million. So how much is my answer here? So to get my answer, I just need to take 300,000 times 0.8696 plus 500,000 multiplied by 0.7561 plus 1 million, multiplied by 0.6575 minus 1 million. We are getting 296,430. Now we have project D. Let us go to project D now. Project D, right? The project D of ours, how are we going to be computing it? Under the project D, so we look on the cash flows. Is this similar? Correct. It is irregular cash flows. So the first one, when you are doing your NPV, you do the same. 800,000, you multiply by the present value interest factor. How much? We are talking about 15%, 1 year, plus 400,000, we multiply by PFIF, 15%, 2 years, plus 400,000 times PFIF, 15%, 3 years, minus 1 million, right? So in this case, it means you take 800,000, you multiply by what? 1.15, right? Which is now the same, 0.8696 plus 400,000. Year 2, it is 0.7561 plus the third one will be 400,000. We multiply by year 3, 0.6575 minus 1 million. How much is this? So 800,000 multiplied by 0.8696 plus 400,000 multiplied by 0.7561 plus 400,000 multiplied by 0.6575 minus 1 million. We're getting 261,120. 261,120. So let us rank our projects. So when you are ranking our project, let me see whether you can be able to see everything. So when you are ranking your projects, you see there are some areas which you cannot be able to see. Let me just adjust for that. One minute. Okay, so when you're looking at the rankings now, you're going to be taking your projects. So here we talk about the projects, correct? We take your projects. We have the NPV. Then we have our ranking. So we have ABCD. ABCD. So project A, it has negative 187, 146. Project B, right? What about the project B? We talked about 50, 340. Project C, we have 296, 296 for 30. Then project D, which is the last one, we have 261, 120. So this is project 1. I think followed by this number 3 and this number 4. That is how you normally rank the projects using the what should we call it? You rank the projects using the NPV. So you start ranking from the best to the worst. That is what we have already done here. Sorry. So we have ranked from the best to the worst, and that is what we have done there. Now, we have to be looking at the computations now, right? We need some computation regarding to the profitability index as per the questions is asking us, right? And examiner is talking about computing this question using the payback periods, or what was it? Let me just check the question on what it is asking about. So rank the project using the payback periods. So when you're using the payback period, we said, number one, when you're using the payback period, we said, number one, we have to be looking on the cash flows, whether they are regular or irregular. That is one. Number two, if they are regular, you are just going to be taking the initial outlay of the project, correct? We said we normally take the initial outlay. You divide by the annual, right? So for example, let me start with the first one now. You'll be able to hear some people getting it wrong for payback periods. Let me just clear this. Let me just leave my NPVs there. So the present value of the cash inflows, for example, we have project A now. Project A, we say to get our payback period, we are going to be taking initial outlay. You divide by the annual cash inflows. So when you look on the initial outlay of our project, for instance, because this project is regular, right? It has regular cash flows. So in this case, the initial outlay of it is 1 million. You divide by the annual cash inflows. What is the annual cash inflows? 500,000. How many years do we require to get back our initial outlay? We talk about 2 years. That is project 1. Project B, when you look at it, project B, here we talk about irregular cash flows. And you ask yourself, what are we going to be getting the payback period when you are dealing with irregular cash flows? And we say, if we are dealing with irregular cash flows, let me take my cash flows, right? We take the cash flows. Let me start with the years, cash flows. Then we accumulate our cash flows. Now, let me start with year 1. Year 1, when you look at it for project B, it generates nothing. So here also, when you're accumulating is 0. Now, when you go to year 2, we were able to generate 650,000. So when you take 0 plus 650, we get 650,000. When you go to year 3, we are generating a cash flow of 850, but do we require 850 to attain 1 million? You say no. How much do we require in terms of the cash flow? You say we only require 350,000. 350,000. So in this case, to get my payback period, it means we are going to be using two full years plus you normally determine the number of months that you require to generate 350. We say, can I be able to take 350,000 divide by the total annual cash flow generated in that year, which is 850,000. So in this case, it means we are going to be taking 2 years plus what? How many months? 350 divided by 850. It means it is 0.41 years. Sorry? Someone was speaking. Now let us go to project C. You do the same. You take the number of years, right? Years. Then after you take the years, you look on the cash flows. Then you accumulate the cash flows. You accumulate the cash flows. So we have year one. We have year one. So year one, when I look on the cash flow generated in that year, the 300,000. So when you accumulate here, you start with 300,000. We go to year two. So when you go to year two, we have 500,000. So when you take 300 plus 500, it comes to 800,000. Then you go to year three. You find I don't require the full cash flow generated this year, which is 1 million. I only require 200,000. Is it 200,000 to attain to 1 million? Yes. Senior. So in this case, it means we are going to be using 2 full years. Plus what? How many months? We take the cash flow generated that year, the cash flow required to attain our initial claim. You divide by the cash flow generated that year, which is 1 million. This translates to 2.2 years. 2.2 years. 2.2 years, right? Now, after this, we go to project B, which is the last one. So when you look on the project B, we say, again, take the number of years, cash flows, then we have cumulative. Cumulative cash flows. So we start with year one. Year one is per project. The last project, it is 800,000. So you put here 800,000. We go to year two. You find in year two, we are generating 400,000. You don't require 400,000. We only require 200,000 to attain to 1 million, which is your initial fee. So how many years are they required here? When you get to a payback period, you say, I'm using a whole year, generating 800,000. So 1 year plus how many months? You say, I only require 200,000 to attain my initial fee. So how many months do I require here? You say, can I take 200,000? I divide by 400,000 to determine the number of months. So it is 1 year plus how many months? So it is 200. How you can talk about 2 divided by 4? Get it 0.5. So in this case, it is 1.5 years. So when they are telling you to rank the project as per the payback period, you take the number of projects, or you take your project there, correct? So once you take the projects, we have the payback periods, then we rank. Then ranking there. So we have 4 projects, which are looking like that. So the payback period for the first year was 2 years. B, we have 2.41. 2.41 years. C, we have 2.2 years. Then year 4, D, we have 1.5 years. Correct. So when you are ranking your projects, unaangalia ile project inakurudishia pesa haraka. You are investing, but it is giving you back your money very fast. When you look at it, it means project D is the best. Yeah. From this one, project A should be the second one. Then we have this number 3 and this is number 4. The project is inakurudishia pesa, your initial capital, very fast. D is the first one, A the second, all the way. That is how you normally rank using the PI. I can be able to tell you if you can be able to repeat the same concepts using the same concept. You can be able to use the profitability index. It will be of great importance if you can be able to do that assignment for practice. Now, allow me just to do a question tested on May 2018, question 2B, unless there is a question. May 2018. May 2018. May 2018. Let me check here. So May 2018, let us go there. May 2018, May 2018, May 2018. The May 2018 is this for advanced, sorry. So let me refresh. Okay. Let me check here. May 2018, sorry for delay. Which is here. Whitney will be able to read for us. Question number 2B, yes. Whitney, you can read, please. Whitney?
May 2018 question 4?
2B.
2B. Okay. May 2018 question 2B. Kubusa Limited is contemplating the acquisition of a new machine to replace the new one currently being used in production process. The existing machine was acquired 2 years ago at a cost of 8 million. The existing machine was estimated to have a useful life of 5 years with no salvage value. However, a critical analysis of the machine now shows that the machine is usable for the next 5 years with a salvage value of 1.4 million shillings. The existing machine can be disposed of now at 4 million shillings. The new machine is expected to cost 12.56 million with a salvage value of 4 million shillings at the end of its useful life of 5 years. The new machine will also require an additional investment in working capital of 2.6 million at the start of its useful life, which will, however, be recovered at the end of its useful life. The following information relates to the estimated earnings before depreciation and tax over the coming 5-year period for the two machines. Kubusa Limited's cost of capital is 13%. The company applies straight line method of depreciation. The corporate tax is 30%. Required. Using the net present value technique, advise the management of Kubusa Limited on whether to replace the existing machine with a new machine.
Thank you so much. You can see we have been given a very simple question there, which we can be able to analyze and understand how that concept should be done. I can see the question is giving us a bit of challenge to bring a lot of knowledge regarding to what we are tackling now. So this question discusses the replacement of a machine, because I can be able to see we are being told there is an existing machine which was acquired 2 years ago at a cost of 8 million. It means that there will be a disposal value of the old machine. So we are going to be following up that criteria. Then it is very simple to remind yourself how and the method that we normally use when you're computing the NPV. So to remember that method, let me just come here and remind you, remember the first method we said, the first stage we said it is the computation of the initial outlay. So we have Kenya shillings here, we have another one there, right? So these Kenya shillings we are having here, right? Let us reduce our shillings into thousands, right? So let us now start our question by going through it, and we are starting with what? So we are starting with the cost of the new machine. So when I'm reading the first paragraph, this is the first or the second, it should be the second one, where we are being told the new machine is expected to cost 12,560. So the cost of the machine is 12,560, right? That is the cost of the machine. 1 minute. That is the cost of the goods. That is the cost of the machine. Then, after you take the cost of the machine, we said we normally do what? Once you get the cost of the machine, we have to be looking at our question, do we have the incidental cost? Let me continue with that. We have been told the new machine is expected to cost 560,000 with a salvage value of 4 million at the end of the useful life of 5 years. The new machine will also require an additional investment in the working capital, which is now, we shall be able to use it later. It means there is no any cost regarding to incidental. So let us look on the costs which we are going to be putting in place there. There is a disposal of the old machine. What is the value which we can be able to dispose the old machine, right? Let me see here. We are being told that in paragraph 1, we are being told in the second line, the existing machine was estimated to have a useful life of 5 years and so no salvage value. However, a critical analysis of the machine now shows that the machine is usable for the next 5 years with a salvage value of 1.5 million. So the existing machine can be disposed of at a value of 4 million. So can we be able to let the disposal value of the old machine? Right? Let's dispose of value of old machine, which we have been told it is 4,000. That is the disposal value. Then, is it possible for us to calculate the tax on gains stock loss on disposal? Tax gain stock loss on disposal, right? So we are going to be starting by taking the disposal value of the old machine, right? Our disposal value of the old machine, we have said it is 4,000, right? This is 4,000 here. Then we are also being told, can we be able to lay the net book value of the old machine? The net book value of old machine. So how are we going to be calculating that? It means we say to calculate the net book value, we normally take the cost minus the depreciation. So the cost of this old machine was around 8 million. Minus, what is the depreciation? I can be able to see that this machine from the first instance, it did not have the salvage value, right? So it did not have a salvage value. So to calculate your depreciation, we take 8,000 minus 0. We divide by the number of years of that machine, which we have been told it is around 5 years. Then we multiply by 2 years. These are the number that we are, this machine has been in existence. To get the total number of depreciation, how much is the depreciation in total? So in this case, it means I just need to take 8,000, we divide it by 5, then we multiply by 2 years, getting a total depreciation of 3.2 million, right? So when you take 8,000 minus my answer, it means you're going to be getting 4,800. Once you subtract, it means you're going to be getting loss of disposal of 800, right? 800. Then we said, this is our tax on tax laws on disposal, right? So in this case, it means to get into tax, we need to multiply by 30%. Remember this negative there. Getting around. Yes.
Why are we multiplying by 2 years?
Because in the first paragraph, we are being told the existing machine was acquired 2 years ago. We need to get the total depreciation based on the number of the years this machine we have been.
Oh, okay.
You see?
Okay, thank you.
So we have been using it for only 2 years, right? And then we want to replace it. So what is the total depreciation for the 2 years? That is what we were doing there. Then from there, getting 240, it's very important for us to get the net cost. Let us get the net cost of the new machine. What is the net cost? It means if you take 12,560 minus 4,000 minus 240, where are we subtracting? Because it is a loss. If it is our gain, we should be adding it. So this is the 8320. Then we add investments in working capital. What is the investment in the working capital? I remember in that paragraph 2, we have been told that the new machine will be require an additional investment in working capital of 2.6 million. That is translated to 2,600. Right? How much is the initial outlay? How much is your initial outlay? Our initial outlay will be 10,920. Let us go to stage number 2. We talk about the computation of the annual net cash flows. The computation of the annual net cash flows. So in this case, how many number of years do we have? We have 5 years. So we have year 1, 2, 3, 4, 5. And then know very well that these annual net cash flows, the examiner has already given you for the new machine and the existing, right? So what am I supposed to be looking at it here? You normally look on the increase in earning before depreciation and taxes. How am I going to be getting it? When you bring the new machine, I can see there will be an upgrade. There is an increase there in the cash flow generated. So in this case, it means, for example, for the first year, I'm going to be taking 5,400. I subtract 3,200, which we have been generating. This translates to around, is it 22? So the first year should be an increase of 2,200. The second year will be 5,400 minus 2,800. We are getting 2,600. Third year, we have 5,400 minus 3,000, getting 2,400. Then we have year 4, 5,400 minus 24, getting 3,000. Then year 5, we have 3,400. Right. Once you get that, is it possible to less our taxes? We say yes. At that percent. So once we less our taxes at 30%, it means 30 of our earning before depreciation taxes. The first one should be around is it 960? Right. This one should be 660. This is 720. Right. This should be 2,400 by, this should be 780, sorry. Then this is 720. This is 900. Then this is 1020. Then we add our depreciation tax shield. Right? Allow me to compute my depreciation tax shield here. So to get our DTS, it means we are going to be calculating first for the new machine. So for the new machine, we need to calculate the depreciation first, right? What is the depreciation? So it means the total cost of the machine was 12,560 minus that this machine has a scrap value. I can be able to see it has a salvage value of 4,000. How many number of years that this machine is in existence, for instance? It's 5 years. So how much is this? So this one will be 12,560 minus 4,000. We divide it by 5, getting 1,712. Then we have the old machine. The old machine we have. What is the total value, right? What is the value of the old machine? So remember today, because already an examiner has told you, let me just put this on charger so that you don't miss. It might switch off. Put my machine, very simple. I'll bring it a few minutes. Now that is okay. Now, when we are looking for the old machine, we had already computed the net book value after 2 years. And then we are already being told there in the past paragraph that over critical analysis of the machine now shows that the machine is usable for the next 5 years. So what is the net book value after 2 years? 4,800, right? 4,800, correct. Then, if it is 4,800, does it have any salvage value? We have been told there, that examiner was saying that in the next 5 years, with a salvage value of 1,500, you divide it by the new estimate, which is 5 years, right? So how much is this? We say 4,800 minus 1,500, you divide by 5 years, getting 660. So how much is this? So 1,712 minus 660, getting 1,052. Then you multiply it by 30%. So 1,052 times 0.3, you're going to be getting 316. Allow me to round off 316. So once you get 316, is the one now that you're going to be putting here. So here should be 316, 316, 316, 316, 316, 316. Correct. So what is your annual net cash flows? Annual net cash flows. So the first one will be 3,200 minus 960 plus 316, getting 2556. The other one will be 2,200 minus 660 plus 316, getting 1856. 2,600 minus 780 plus 316, getting 2,136. The other one will be 2,400 minus 720 plus 316, getting 1996. Then you have 3,000 minus 900 plus 316, we get 2,416. Then the last one will be 3,400, right? Minus 1020 minus plus 316. We are getting 2696. 2696. 2696. Now, in that case, after you get these answers, it is very important now to go to the next and the last stage, where we are discussing about the terminal cash flows. Number 3, terminal cash flows, right? Another terminal cash flows, we said we normally take what? We normally take the scrap value of new machine, which we have already been told it is 4,000, right? That is the scrap value of the old machine. Then we less the scrap value of old machine, which we have already been told it is 1,500. Then we add investments in working capital. The investment in the working capital, you can be able to see, as per the question you are being told, it is 2,600. So what is your terminal cash flows? What is your terminal cash flow? So in this case, your terminal cash flow will be 4,000 minus 1,500 plus 2,600, getting 5,100 here. Getting 5,100. Once you get 5,100, then the question becomes very simple. So because the examiner was asking us, using the net present value technique, advise the management. So can we be able to advise? Yes, we say yes, we can be able to advise. So how are we going to be advising? Very simple. So allow me to wrap the first part. Let me just wrap here. So once I have this question, I'm not going to be panicking now. So once I get that, I just come here. I take now the number of years. We take our cash flows. We have been told there is a discount factor at a certain rate. What is the rate given? The cost of capital of ours is 13%. We get our present values. So the number of years we have only 5. So we have here 1, 2, 3, 4, and then number 5, we're going to be having 2 cash flows, 2696 and the terminal cash flow. So the first one will be 2556. Second will be 1856. The third one will be 2136. The other one will be 1996. Yeah, we have 24, 16. Then the last one will be, I messed up. So 25, 56, 18, 21. Where are we? There must be a problem somewhere. So the first one, let me just look at it. The first, it should be 2200, 660 minus that, getting, the first one should be 1856. This is the recover, please. It should be 1856. The second one, 2136. Well, the other one is 1996. We have 2416. We have 2696. And then the last one should be 5100. 5100. Now, after you get all that, you just need to take your calculators. When you look on your calculators, they are lump sum. So it means the formula to use is 1 plus r, we raise for negative n. So in this case, it will be 1.13, we raise for negative 1, getting 0.8850. The other one will be 2, getting 0.7831. Number 3 here, 0.6931, 4, 0.61. Then we have 0.5428. Then also here is 0.5428. Correct. Now take your cash flow, you multiply by the discount factor. The first one will be 1856 times 0.8850. Here we are getting 1643. Allow me to round off. The other one will be 2136. We multiply by 0.7831, getting 1673. We have 1996. We multiply by 0.6931, getting 1383. Then we have 2416. We multiply by 0.6133, getting 1482. The other one will be 2696. Multiplied by 0.5428, getting 1463. The last one will be 5100, multiplied by 0.5428, getting 2768. So what is the present value of the cash inflow? What is that? Now, get your present value of the cash inflow. It means you take 1643 plus 1673 plus 1383, right? Plus 1482. We add 1463 plus 2768. 2768. We are getting 10,412. We less our initial claim, which is 10,920. So what is your NPV? Minus 10,920, which is 508. Which is 508. Now, when you're looking at it, you will be able to find your NPV is negative, and you can be able to advise them that the existing machine should not be replacing it will be able to reduce the shareholders as well, though something regarding the NPV is negative. But if, for example, the examiner was asking you to calculate the IRR, because this is positive, you can be able to see this negative now. It means you need not to calculate using a different discount factor at a certain rate. For example, you can be able to talk about 4%. When the NPV is negative, for example, you are at 13%, it means you have to be coming down, right? You can see now you can be able to come to 4%. That is how the concept of the trial and error experiment under the IRR is talking about. So if you get the discount factor, the 4%, it means you are going to be multiplying, you get the present values there, right? You multiply your cash flows with your discount factors, you get the present value, right? Then you subtract it, you get the positive NPV. Then you're going to be applying the formula which I showed you as per the requirements of the formula. Now, I just want to give out an assignment. So we have only 2 questions here to do. Assignments, right? So if you want to do an assignment here, you just need to go and look on the question they tested on November 2017, question 4C. Then you have another question here. There is another question they tested on 2016, right? November 2016, there is a question there. Just go and look at it relating to all of these. So just go there, look at the questions, just do for practice. Just do these questions for practice. Now, after you do all that, it's very important for us to engage on something different. I just want to look on the capital rationing. And we said it is referred to a situation of capital limitation, right? So when it talks about capital limitation, it means we don't have enough capital to run specific projects. For example, we might be having, for example, 10,000. That is the capital that we are anticipating to use. But when you look on something that you want to invest on, it requires 15,000. That is what we talk about capital rationing. Now, that is being challenged by the availability of the capital to run specific errands that you think will be able to assist your business prosper. So we are seeing that where the company is unable to undertake all the project with positive NPV due to limited funds. So such limitation can either be caused by the external factors or which are beyond the management's control, which we normally call them the external capital rationing, or internal factors which are within the management control, which we normally call them the internal capital rationings. Now, from that case, we say, what are some of the causes of the ad capital rationing? And we say, the firm may be unable to raise enough funds due to the following. 1, existing financial obligations. Those are the contract restricting additional borrowing. Second, we have the lack of asset to pledge as a security. Those are the collateral for additional borrowing. Then we have the investors may be unwilling to increase their investment in the firm. Then a company that is not listed may be unable to raise any additional funds through the issue of ordinary shares to the public for subscription. Now, what are some of the causes of the SOP? Now, we are talking about the management may implement some measures which will result in the company not being able to raise the required amount for undertaking all the profitable projects. For example, number 1, we are saying the management may avoid issue of additional debt so as not to increase the firm's gearing ratio, firm's gearing risk. Secondly, we are saying that the issue of additional debt may be avoided so as not to increase the fixed finance cost of the in form of the fixed cost in form of interests. Then we are talking about the issue of additional ordinary shares that be avoided so as not to change the firm's voting structure. Then the management may opt to maintain investment at a level that is fully financed by the internal funds. So when evaluating the project and the capital rationing, such projects are rated using the profitability index for optimal allocation of the limited available resources. So when you're doing this question regarding to or relating to capital rationing, I will be able to remind you about the types of projects which we were discussing earlier on, the investment projects, and you can be able to see there is a concept I was able to teach you regarding to the divisible and divisible projects. And we said that the divisible projects are projects that can be scaled downwards, hence implemented. You can just be able to implement it partially, while indivisible projects cannot be scaled down, and that is the concept which you're going to be using here. To be able to understand this concept, it's very important for us to do some few questions here. There is a question they tested on May 2016. Let me check on that question, which should be forming part and parcel of the, which would be the last thing we have to be doing here. So, let me see. Okay, so in 2016 here, in 2016, let me just go there. It is May 2016. Tuangalia 2016, how the question was being tested and now what you need to know. May 2016 is here. So we have been told here, question 4D, the examiner was asking us, Lainika Limited has identified 5 investment projects with the following details. So remember here, examiner is using a bit of trick. So he has given you the investment projects, he has given you the initial outlay, but has also provided you with the net present value of the investment. Anakuambia vizuri pale, additional information, none of the investment projects could be delayed. Number 2, you can see none of the investment projects could be delayed. Amounts available for investments are already provided here, which is 300 million. Therefore, the company cannot undertake all the investment projects, and we are being told all the projects are divisible. It means we can take some partially, correct? So, but if they were talking about being indivisible, it means you could not be able to invest or to take part of any project. So required here, we have been taught to advise the management of Lainika Limited on the most appropriate investment projects to undertake. So nikipatana swali kama hii kwa mtihani, what am I supposed to do? So it is very simple, then this is what to normally do. So that when this question comes, you just need first thing to remind yourself about the formula for the PI, because we have said we normally rank our projects using PI, so it should be question number 4D. So in this case, it means I have to remind the formula to complete the PI. And we say, to get our PI, we normally take the present value of cash inflows. We divide by, right? We talk about our initial. And you remember very well, when we were doing our computation for the NPV, what did we get? We used to take the present value of the cash inflows, the present value of cash inflows, then we subtracted our initial pay. Remember, the examiner has not given you the present value of the cash inflow. So what am I supposed to be doing? I'm supposed to be taking these plus the initial pay, correct? We're supposed to be adding the NPV plus the initial pay to get the present value of the cash inflows, correct? Now, let us go to the to our projects. We say we are having some certain projects here. So how many projects? We have 5, A, B, C, D, and E, right? What is the initial play? So initial play is provided by the examiner there. We have been given 120. We have 120, we have 160. We have 100, we have 90, and then we have 110. Correct. We have the present value of the cash inflows. The present value of the cash inflows. How am I supposed to be getting it? And I say, to get it, I need to take the NPV plus the initial play, right? I can see the NPV already provided. So the first one should be 120 plus 24, getting 144, right? The second one will be 160 plus 43.2, getting 203.2, correct? Then the other one will be 100 plus 17, getting 117. The other one will be 90. We add something called the 21.6. This translates to 111.6. Then the last one, which is the 110 plus 19.8. 19 point something, 0.8. This translates to around 129.8. 129.8. Now, let us compute our PI here. And we have said the PI, we are just going to be taking the present value of the cash inflows, you divide by the initial pay. The first one should be 144 divided by 120. The other one will be 203.2, you divide by 160. The other one will be 117 divided by 100. The other one would be 111.6, you divide it by 90. Then the last one would be 129.8, you divide by 110. Now, very good. Take your calculator out and we say, let us rank our projects and we look at. The reason is by the way we are ranking our projects is because you want to know which project is the best. So you start investing from the best to the worst. So the first one is 144 divided by 120. We are getting 1.2. Higher, 2 or 3.2, we divide by 160, getting 1.27. I'm 1.3. Higher. When we talk about 27, let me just to use it. Now, this should be 1.17. The other one is 111.6. You divide it by 90, getting 1.24. Then the other one would be 129.8 divided by 110, getting 1.18. Then you start ranking your projects, right? You can just be able to rank your projects. Now, the projects are ranking from the best. And when I look at it, project B becomes the best, followed by project D. We have project A. This is 4 and this is number 5. That is how it should be. Now, after you rank, you need to look on the optimal allocation of the resources which is available. So optimal allocation of resources. How many money do we have? Kenyan shillings, 300 million. So let us start by investing on the projects which are going to be giving you the highest as per the ranking. So we have our projects here. We have projects. The project number 1 is project B. What is the initial day of project B? We say project B, because it's giving us the highest return, is 160. We invest everything on it. We go to the second one, which is project D. Is it D or E? I'm not project gun. Project D, right? Now, project D requires an initial day of 90. We can be able to invest on our third best, which is A, right? How much is remaining here? So when you look at it, 160 plus 90, we get around 250. It means because we are being told the projects are divisible, then we can be able to invest in A partially, which we are just going to be investing 550, sorry. We're just going to be investing 50. And then we have already exhausted the available resources, which is 300 million. Correct. Once you finish that, it's very important to calculate the NPVs of these projects, right? You remember, you have the NPVs of the first projects. So the project B, you have the NPV of it, which you are being told is how much? As per the question, the NPV of project B is 43.2. Then project D, we are being given an NPV of 21.6. But project A, how much is it? We say, because we only require 50 of the, for example, 120, we require only 50 million. What is the proportion so that, because the NPV which is provided in the question is for the whole amount required to invest to undertake project A. So in this case, it means you have to be getting a proportion by taking 50 divided by the total capital required, right? Total required. Then you multiply by the NPV of project A, which is 24 million. So how much will be the NPV for 50? Because when you take 50 over 120, you're going to be getting a certain proportion. Then you multiply by the NPV of the whole 120. How much for 50? So very simple, it's just say 50 divided by 120, getting around 41.67%. Then you multiply by 24, getting 10.
10.
Very good. We get 10. So what is the NPV of the project which are visible and which you are able to get? What is the total? So in this case, to get the total, to me this is 63, 64, 74.8. 74.8. And that is how you normally do the question. For example, if the examiner had already given us an additional information and says, all the 5 projects are indivisible, it means we could not be in a position to invest 50 million in project A, and you could just be able to work for project B and D, which was 160 and 90, and then you could have a surplus You could just come and you tell the examiner, we have a surplus of Kenya shillings, 50 million. If this was the case for indivisible projects, if this was the case, then it means you could not be in a position to invest the 50 million. It means you could just, if we cannot be able to undertake fully, then you just need to leave it. That is the case of indivisible. But our question was talking about divisible. And when it comes to the divisible, it means you can invest partially of that specific project, Now, I think that one you can be able to understand up to that point. After that, now, it means that we have concluded the topic of capital budgeting, unless there is any question, right? If there is any question you have to ask. But if we don't have any question, I will just be able to remind you that I said my students should be able to go and learn about the working capital management. The working capital management. These are the video. It is a video which I shared some time back. The working capital management 1 and the working capital management 2, right? Then it means if we are going to be checking on this, we are going just to be checking on there is a topic called the portfolio return, which we cannot be able to work on it right now. Then we have another topic here, which normally talks about the ratio analysis. So next week, because this one cannot take us even a full class for the portfolio theory, it means we just on Monday do the portfolio theory, portfolio returns, and we look at what is a portfolio and what does it entail, and how do we normally measure the portfolio risk. Then once we finish up with doing some few questions regarding to it, then we are going to be focusing our attention to the ratio analysis. And this will be our last topic now, right? We're going to be running with it. It is a very crucial topic. It doesn't miss in most of the syllabus, in most of the semesters. So it is very crucial to us. And it is the last thing that we're going to be doing. So the working capital management, I want everyone to go through it. Make sure that you understand the concept provided there, or that I was able to explain there. If you don't, then it doesn't mean that tusemaje ati kuuliza ni ujinga, hapana. Uliza vizuri, uliza tu. We uliza, as long as you want any explanation, we are going to do so. Then the aspect of the ratio analysis, once we complete it, because it's a bit wide, I will be able to to brush off. It means that there are some of there is some of the introductory notes which I've already provided in our WhatsApp group. And also we have already discussed about the types of the ratio analysis. It's very crucial for you to go and learn about them, right? Then when we meet on Monday or Tuesday without any failure, it means that we'll be in a good position to say that the third week of March, we'll be able to complete our syllabuses, and then we start our revisions. So that is what I have for you today. Any question?